All right. Hello, hello, hello. Can everyone see me? Can everyone hear me? Hello. I wanted to get straight to it. Skipping the 5 minutes. We know that. We know that. Let's dive straight into it, right? All right. How is everyone doing? Good evening, good morning, good afternoon, whatever your current time zone is. Hello, Andrea. Lovely to see you. Hello, Said. Hello, Abbas. Great to see everyone. Hello, Brian Griffin. Hello, Youssef. Elias. Terry. Hello, Dave. Rohit. Absolutely love to see it. Welcome, everyone. Welcome, welcome, welcome. I'm doing good. Thank you. Thank you. Doing very good. How are you? Hello, Raf. Hello, Daniel. Can't wait for today's topics. Love to hear it. Love to hear it. First time here. Welcome, Rebel. Welcome. I hope you'll learn something. That's the goal, eventually. Since I met your concept, my trading has improved. Love to hear you, Jones. And again, it's also credits to you, my friend. Credits to you. Hello, Tanzir, Sanjay, Matt. Hello, Kim. Hello, Paul. How are you doing? All right. I'm doing good, Percy. How are you? Thank you for asking. All right, Perks. Exactly, Elvis. Exactly. First time. Welcome, Edwin. Welcome, welcome. I hope I pronounced that correctly. Do you trade on gold? Yes, I do trade on gold, but I do use the futures chart, which is slightly different, but overall it's very similar. For sure, Andrea, if you help remind me about the breakaway gap and the indicator, then feel free to. Feel free to remind me and we can go over it, for sure. It really depends on your trading plan. We can also dive into that. When I have a good setup but no news, do I still trade? Depends on what type of trader you are. If you're, for example, a swing trader and you're more so reliant on the higher time frame, I wouldn't be too worried about that you don't have news on that specific day, as long as there's some news throughout the week or in the coming weeks right there. So it depends on quite a lot of factors, if I'm being honest. I'm working on your A to Z guide. Love to see it. Love to see it. Love to see it. When will you buy the bull? I actually need to still remove the bear, to be honest. It's from Christmas, but I haven't removed it yet. It's quite, otherwise it's so empty there. It's quite nice. How can I join your MMT team? Barry, you can go to tradingmmt.com and all the information is there. That's tradingmmt.com. And you can also send us questions at info@tradingmmt.com. Do you pay a lot of attention to incoming volatility? Yes. Volatility is very important. Very important for me. 100%. Yes. Dollar showing signs of seek and destroy. You are not wrong, my friend. How big of a factor is psychology? Some would argue it's not relevant. Some would argue it's the most important. I think it's quite important, especially as retail traders. It is very important to understand what happens in a market. And the reason why I think it's so important, if 90% of the traders is not profitable, then there's a certain reason behind why that is, right? If it was just concepts, if it was all about concepts, then everyone could learn the same concepts to a certain degree and would be profitable with it, right? If that makes sense. So if that's not the case, then there's something else underlying going on. And I think that's a large part also psychology. So I think when you take someone's liquidity in the market, on the other side of the trade, think how many people are over trading, revenge trading. I think a lot of it comes down to psychology, actually. So that's why it's so important. Who can keep their psychology in check the longest? That's going to be the profitable trader. Dollar's confused. Yeah, let's dive into it because the dollar is quite confusing. First of all, let's see right here. We'll go over the topics afterwards as well, and we'll see what we want to talk about, etc., etc. But first, let's go over the forecast, and then we can add certain topics. So I saw, for example, breakaway gap and the indicator right there, which we can also dive into as well if we do want to. If you have any topics that you want to go over afterwards, feel free, and we can also type it down here so we don't forget. Okay, let's see what we have. First of all, let's dive into, this is the right one. Let's dive into Forex Factory. What do we have? This upcoming week, quite an, well, how do I say this properly? Quite an empty week, if that makes sense. If you look at the difference between last week, what we had right there, and this upcoming week, what we have, it's more so empty. And the thing that we do have to take into account as well is that we have CPI on a Wednesday right there. So for me, a usual protocol is that I'm quite careful with Monday, Tuesday, and Wednesday trading right there after CPI has happened. Then I'll potentially look to get involved on Thursday and Friday. But this also means that since we have had NFP, FOMC statement, and we have also now had CPI, it usually means the weeks afterwards, right there, they clear up. So the weeks until we start approaching, again, FOMC statements and NFP right there, those are the weeks where, according to my data from my trading plan, is where we have better price action. Again, differs from trading plan to trading plan right there, of course, but that's something to know for yourself as well. So if we then dive into the price action itself, what are we looking at? We are looking at interesting but difficult price action to understand. So let's break this down fully. What are we doing? Again, we are coming from this weekly fair value area that we had right there and a fair value gap, of course. Then the first candle was not a rejection like we saw. The second candle swept the previous candle low. So it's just a normal, typical two candle rejection right there that we see. Everything up until then, perfectly fine. Then Monday happened. And Monday was a very large move up initially. So let's get back to this right here. Let's remove this. Monday was a very large move up, meaning that we were all the way at the top right there, and then we came all the way back down. Now, what does this do? This creates a rejection fair value gap. What is a rejection fair value gap? Again, it's where the momentum against our trade is so large that it creates more momentum against our trade than the fair value gap size in itself. So to get an ID, for example, we have around, 1,300 points right there against us, and the fair value gap itself is only 94. So that's, of course, a large difference right there. So that third candle, that tells us there's a lot of momentum at that moment in time against our bullish trade ID. You don't want momentum against your bullish trade ID because that's not good. You also don't want momentum against your bearish trade ID. You, in general, don't want momentum against your trade ID because that leads to potential consolidation or deep retracements as well. So we understand, and I like to use the train analogy in that sense as well. We understand when we have a rejection fair value gap, you simply can't expect a sting into it to then continue higher from it. It's not logical. Why? Think of a car, think of a train. When they are going at high speed, you don't just brake and you stand still and you can reverse immediately. No, it takes a while before you fully come to a stop right there and can then reverse. It's the same in the market, the exact same. When there's so much momentum going against us right there, the market, before it wants to turn around and potentially be bullish, if we do want to continue higher, we will have a deep retracement before potentially continuing higher right there. So what we see is that this creates this bearish fair value gap. Okay, I need you to understand, is that bearish fair value gap at that moment in time very interesting to trade from? Short-term movements, I think, throughout this week were quite interesting. Long-term movements, not necessarily. And let me explain why. Because coming into this week, overall, at least myself, I was very bullish. So when I come into a week and I'm very bullish and I'm expecting higher prices and we see a Monday like that, a Tuesday like that, then do I all of a sudden want to get impulsive and now switch my buys around? No, I don't want to do that. So what happens afterwards? We start to now fail to continue lower. Okay, two candle rejection again. First candle right there is a rejection. So second candle ideally should have been an expansion phase candle to continue lower, create that new value gap to continue lower from. Did not happen. So now we are looking at potentially running this rejection. And in my opinion, what I want to closely monitor for next week is see if we can create new fair value gaps right here, run the high to then be bullish again right there, to switch bullish again. If that does not happen, then we also need to pay attention very closely to a potential consolidation. Someone mentioned it earlier on in the chat right here as well. And they mentioned dollar looks like seek and destroy. And that is true. And why is dollar potentially looking like seek and destroy? Because bullish and bearish fair value gaps at this moment in time are not following through. We are getting ugly two-candle rejection. We are getting a lack of new fair value gaps. We are getting a lack of respecting fair value gaps. Those are signs that we are potentially in seek and destroy, which is essentially just a consolidation. So be very careful around that as well. Personally, I wouldn't mind waiting for CPI first to be over, and then potentially afterwards, if CPI shows its hands, to then potentially get involved as well. Overall, I would still like to see higher prices. But with the rejection that we saw last week right there, I'm a lot more 50-50 than previously right there. So be very careful with whatever you're doing at this moment in time on the dollar as well. There's no shame, by the way. This is very important to understand because we talked about this a little bit in a previous live stream as well last week on Sunday. And there's no shame in not knowing a bias at that moment in time because that's what trading is about, right? Trading is about when you do have a clear bias and your edge does present itself to then potentially get involved. So when that's not the case and the bias is not clear, you're not too sure what's going to happen in the market, there's no shame in staying out of the market and simply accepting the fact my edge at this moment in time is not present, so it's low probability for me. That's very important to understand. Again, for short-term movements, potentially some interesting moves. Long-term, if we are going overall higher or lower right there, it's quite 50-50 for me. All right, Russell right here. Let's see what we have. So we tried to push higher, and the indices, they have a similar theme that we have had right now for the past couple of weeks. And that theme is the following, that at the beginning of the week, we have this large gap lower right there, like we saw in this week, like we saw in this week as well. And afterwards, we start to slowly climb back higher again. Again, for me, those moves lower right there are still sort of a manipulation because I would still like to see an all-time high right there being reached, or at least reach above these liquidity areas right there. So let's say we do want to potentially continue lower, then still in the short term, I do still think we can continue higher because we are going to need that liquidity right there to trap people to then continue lower from it right there. So I would still like to see on the indices right here, simply said, higher prices. How can we see higher prices? Well, ES, very similar to what happened last week, is see, once we do come into this fair value gap, the bearish fair value gap, if we can disrespect it right there, to then slowly climb back higher again right there. Now, if that does not happen and we do respect this fair value gap, perfect. Then you look at lower prices right there instead. So overall, for me, I would still like to see higher prices right here on the indices as well. Australian dollar, US dollar, and the majors in general then become a lot more tricky. And the reason why they become a lot more tricky is because of the fact that the dollar is not necessarily clear in the long term. Now, in the short term, it's all about reacting. So for example, what we saw last week is we had some short-term, very interesting movements right there, where we came into this fair value gap right there on GU, came into this fair value gap right there on GU, pushed higher overall towards that clear target right there, and then dropped off heavily. EU, very similar price action as well. Australian dollar, US dollar, also very similar price action right there. Over on the short term, there were some interesting moves, yes. But long term, I'm still not 100% certain on what we want to do at this moment in time. So I would personally like to stay out. If I have to then force an ID right here, then arguably what we're looking at is this unusual context where this fair value area is getting disrespected right there to then potentially push higher, target the liquidity. But again, unusual context, usual context is not that reliable if we are talking about a potential consolidation on the dollar. So it's something to take into account. Again, personally, I'm very 50-50 at this moment in time. Not too certain on what it wants to do. I would prefer if the dollar does push higher and EU, for example, starts to push lower again right there. All right. Then for the rest, majors, also not necessarily that interesting to me, if I'm being honest. There's a lot of confusion, a lot of different variables that I don't personally like. So I would prefer to wait until we have a more clear direction overall as well. Gold. The direction has been very clear on gold. And simply said, last week we had, again, that is what? The 4th week in a row, arguably, where gold has been providing setups and where gold has arguably somewhat made the week, if that makes sense. And what I mean by that is that gold, the bias has been clear, all-time high. Then after reaching an all-time high, for myself, it's always a little bit more tricky. And the reason why it's a bit more tricky is because we can potentially consolidate a little bit more as well after reaching an all-time high, which I personally don't like. And after we do have a retracement back into this daily fair value gap right there, then what do we see? On that Monday, we got absolutely brilliant confirmation right here from the daily fair value gap. We got beautiful confirmation right here to push higher right there as well. On the 4 hour afterwards, we got again staying into those fair value gaps to again just keep on pushing higher and higher and higher. And afterwards, later on in the week, during the Thursday live session, we discussed this in the MMT actually. We have this fair value area right there, which we can potentially push higher from. We have this fair value gap right there. And what we see is that we create unusual context. So if we want to offer fair value to continue higher from, then we reach above fair value area high, we can create a retracement to then continue higher from it. So what do we see here? We try to push higher from it right here. Fail to do so. Instead, respect this bearish value gap, create a new bearish value gap. This is textbook unusual context to then target these lows right there. That's absolutely a beautiful price action in general. And you can see the same cycle repeats itself, right? There's actually going to be a video about this specific topic as well. We have this fair value area. If we are offering fair value, then we retrace back into the fair value area right there to continue lower from it. Instead, what do? We try to push lower, fail to do so, create bullish fair value gaps right here to continue higher, and then target the liquidity in the form of the fair value area high right there. That's known as unusual context. It's quite an important topic to understand. It's in itself a trading plan, arguably, right there as well. But that's very interesting price action again on gold. Overall, we are currently coming from an all-time high. We have reached that all-time high again. Again, personally not a big fan of that. When I do look at this price action, we are potentially sweeping that high right there. Let's see what we have. It's also a fair value area right there. Right there. We go into the lower time frame, 1 hour right here. It's still in the middle. So if we do want to push higher, we can still push higher from this right there. But with the fair value gaps that we have in this sharp turn right here as well, wouldn't surprise me if we do see short-term lower prices right here on gold, targeting these lows right there. Again, that's reacting, seeing if we do create this bearish value gap right there or a bullish value gap and we still continue higher. So that's waiting as well, waiting and seeing what the market is presenting. Silver. So silver didn't reach an all-time high just yet. In general, hasn't reached all-time highs in quite a while. But overall, silver, in comparison to gold, just doesn't really have a great delivery. So it's just been quite ugly price action. It tries to push higher, fails to do so, etc. Tries to push lower, fails to do so. So it's not great price action on here on silver. I would still prefer gold overall. All right, Bitcoin. Very, very odd price action that can absolutely confuse your head. So we're looking at a very similar price action like we just saw on gold. Unusual context where we have this fair value area right there. We reach this all-time high, we potentially sweep it. The reason why those areas, those liquidity areas are so important to understand is because even, like we mentioned earlier, even if we do want to continue lower, it's very important to understand that we're still very likely to reach liquidity right there to then continue lower from it. Again, price, and the way you need to see it, price can't simply move lower or higher at any given moment in time. There are certain rules in the market, for example, fair value rules. There are liquidity rules in the short term as well, how the market moves and operates, etc. So the market is not a straight line down or a straight line up right there. It would be very easy, actually. It would be lovely, but it's not the case. So if we want to continue lower, then what you'll see is that a lot of fake tops get created right there, then have fake movements right there to then sweep those highs one last time to then continue lower from it right there. So what we call fake tops and fake bottoms in the market. It's how the market actually creates reversals. And it's because of the fact that the market, if it wants to continue lower right there, then it needs liquidity. So it needs to trap people right there that think there's no end to this. We can always continue higher right there. Trap people. Where's the liquidity at those lows right there? The same thing right here on Bitcoin. So if we do want to continue lower, it's perfect unusual context at this moment in time where we still try to push higher right there a couple of times. Instead, we create those bearish fair value gaps right there, which as of this moment, we are respecting. I'm not a big fan of this move against our fair value gap, our bearish fair value gap. Why? Because it's momentum against our trade. I need you to understand. I mentioned this a little bit earlier. If you are looking at a bullish ID, then the biggest low probability factor that you will have is that you will get bearish momentum against your trade. If you are looking at a bearish trade ID, then the lowest probability factor that you're going to have is bullish momentum against your trade right there. So let me draw this actually. This is why I brought this, because I can draw things very nicely right here. Let's draw this. If we are, let's say, bullish, then we can be bullish by having a move higher right there. Now, the reason why we create a retracement right there is because we're also arguably a tiny bit bearish in general, right? So it's important to understand when we do create a retracement, we might be 80% bullish, 20% bearish right there. This is the reason why we create a move higher, why we create a retracement back into a fair value gap, for example, to then continue higher. It allows the retracement to happen. If we are 100% bullish, then what happens is we just move higher like this, where we just create those breakaway gaps. There's no stopping price, there's no retracements. It's quite difficult price action to trade. It's not ideal. We ideally have price action being somewhat bullish, somewhat bearish, but also not too bullish and not too bearish. Why? Because if we are, let's say, 60% bullish, 40% bearish, then we create very deep retracements right there, where we are getting closer to a consolidation. Why? A consolidation, at its core definition, is 50-50 price action. What does that mean? We are 50% bullish, 50% bearish. So we are not strong enough for either side of the market to push either higher or lower right there. So when we create a 50-50 price action right there, there's signs to it. There's always signs that a potential consolidation is around the corner. And what are those signs? It's momentum against your trade. So this consolidation was the most predictable consolidation that we have seen in a while. This consolidation on the dollar that we are currently seeing right there is a very predictable consolidation. Why? Because on both sides right there were signs. So we were bullish right here, but all of a sudden we got a lot of bearish momentum climbing closer to 50-50 price action, if that makes sense. You need to see it as a scoreboard. At any given moment in time, when we take a look at Bitcoin, there's arguments that will tell us how bearish, how bullish a certain instrument is. When something is 80% bullish and there's slight 20% bearish right there, perfectly fine, because that allows us to create a retracement to get involved. But if the retracements are becoming too strong, the momentum is too strong against our trade, we might be 50-50, where we are getting very close to consolidation. So momentum against your trade ID always leads to consolidations. I need you to understand this, because this is the biggest giveaway sign where people say, well, this was an obvious fair value gap right there. Why didn't it continue lower from immediately? Well, first of all, if price was truly that bearish, it wouldn't have traded back into this fair value gap. It would have created this fair value gap right here and then continued lower from that. But since price had so much momentum against our trade, what happened? We created such a deep retracement, which leads to then consolidation. So when we create a consolidation, it's not nice in general. It's more difficult to trade. Overall, at this moment in time, we are still respecting those bearish fair value gaps. So I do think we can right here continue lower from it as well. Looking to target this fair value area low right there. That could still be interesting in my eyes. But again, if we do not respect that, and instead we start to create those bullish fair value gaps again, start looking at the all-time high right there. All right, crude oil. Not that interesting. It's just been staircasing lower. So this is somewhat of a consolidating trend where we create deep retracements, but we consistently still continue lower. Just don't like it personally. crude oil right here and don't like it in general. And I would like to stay away right here as well. So on Bank Nifty, if you don't trade Bank Nifty, I would still love for you to study Bank Nifty, because Bank Nifty once in a while has really textbook price action and really great price action. So let's break it down. What are we looking at? Well, Bank Nifty, we could potentially have a retracement back into this bigger fair value area that we have right there. So to sketch your ID, this is the fair value area that we have right there. Overall, initially I was bearish, so I would have liked to see price continue lower towards the low, but we react. So what happens right here? We have this low that we sweep right there, where we start to target this high instead. Why? It's unusual context again. So we try to push lower right here through these candles right there. And instead, what we do is we fail to push lower and we create the new fair value gaps to continue higher to target the liquidity right there. Afterwards, once we arrive into those fair value areas on the weekly, what do we see? Read the momentum story. So keep a scoreboard for yourself. This is such a big factor. We talk about this in MT a lot. Again, trading is not necessarily about the concept itself. Well, yes, it's about the concepts, but the concepts, they tell you a certain story. If you don't know how to read the story, it's going to be very difficult. So concepts, first of all, creates a process, and that process creates an understanding of what is high probability and low probability. That's what we emphasize on so much. It's very important. There's a huge difference between what we talk about here on the YouTube, that you see just concepts, and the MMT, for example. Now, without further ado, let's see right here what we have. So we have this 1 hour fair value gap that we can potentially continue lower from. What happens? It's large momentum against our trade right there. It's not a good sign. It's never a good sign. Momentum against your trade, never a good sign. So what happens is that we try to push lower. We sweep this low right there. Then what happens? We create this unusual context to target this high. This then turns into a what? Turns into a flip fair value area. A flip fair value area is a fair value area that flips essentially a bigger fair value area that we had towards the left. So this is a beautiful area that we can potentially continue higher from right there. And if we do continue higher from it, and a new all-time high is not too crazy right there. Now, I know people are probably already asking it. Let's also then look at Nifty 50. Let's see what we have right here. Probably similar price action. So we try to push lower right here from this fair value gap. Instead, we are potentially sweeping this low right here. Now, what are we doing? We discussed this last week, but I want to see the updated version. We have this fair value area as well right there. Currently, it's not looking too crazy. We have the fair value area that we had to sting into right there to continue higher from overall. Now, overall, I would lean more at this moment in time still, like we mentioned last week as well, towards higher prices right here on Nifty 50 as well and Bank Nifty right there, which both are quite interesting. If we have to discuss between Nifty 50 and Bank Nifty, I would say Bank Nifty at this moment in time is more interesting than Nifty 50, if that makes sense. So those are a few things that that really stand out. And I also need you to understand fair value gaps, they are very nuanced to a certain degree. And what I mean by that is the bigger the fair value gap does not mean the better the fair value gap. So oftentimes in especially a little bit older videos, you'll hear me mention the smaller the fair value gap, the less I like it. Because if you really need to zoom in to a certain fair value gap to see if it is truly a fair value gap, then that usually means, for example, right there, I can't really see if that's a true fair value gap, or if I need to zoom in right there to see if it is a fair value gap. Well, it is a fair value gap right there. Okay. Those fair value gaps are usually not universally agreed, meaning if it's a tiny fair value gap, that means on different brokers, there's no fair value gap. So it's not universally agreed in the market that there is a fair value gap, if that makes sense. Now, that also does not mean that the bigger the fair value gap, the better the fair value gap, because that's not true. Because the bigger the fair value gap, oftentimes, the more manipulation there is. And you can study this for yourself, but the bigger the fair value gap, usually what that means is the deeper the retracements, the more manipulation happens. Where the first fair value gap that we have right there is very often is just manipulation right there. And this happens a lot. For example, on the indices, those large gaps lower is usually not a sign of we have a lot of momentum right now that we can continue higher from. No, or lower from. No, it's usually just manipulation in the market to instead do the opposite. It happens very often. So it's an interesting topic to study if you do want to as well. Hello, hello, Sadaf. How are you doing, sir? Let's see. There's a few things that we can first of all go over the following right here, which is that breakaway gap indicator. Now, is there some things that do pop out to people that we do want to go over as well? Let's see. Give me a few topics. Suggest a few topics if you do want to. Let's see. Let's see. Thank you, Goikar. Thank you. It's all about probabilities, and that's something I think is so important to understand. There's no concepts in the world that will tell you there's 100% going to happen something or 100% win rate, etc. It's just not true. It's all about stacking up probabilities. So the way concepts work as well is concepts are a tool to measure their probability, if that makes sense. That's very important. Let's see. Let's see. Candle rejections. Sure. We can look at it. Yeah, the breakaway gap indicator is now available again. It was TradingView took it offline for a moment, but it's back again. Fair value area, so interesting. I love talking about fair value areas, and there's going to be a video on it as well. Candle rejections. We can just name it candle signs right there. It's always if this then that, if that then this. Yes, AT trades love that. Yeah, that's very true. That's very true. Love from Punjab, India. Love to see it, my friend. Yeah, it's very true. And that's how you make things as objective as possible, by saying, if this, you start doing that, if etc. etc. It's beautiful. It's beautiful. Let's see. Stick entry. Stick entry, arguably, candle signs. It's very similar. We can go over it as well, but it's arguably the same thing. Let's see. We talk about the forecast. 2 candle rejection. Sure, sure. Is 90% win rate possible? It's possible, yes. But I wouldn't aim for it. I wouldn't have it as a realistic goal at the beginning. Over a long period of time, 90%, it's very difficult. Very difficult. It's not a realistic expectation. Let's put it like that. Fair value area on detail. Okay. Okay. Let's go into it. First of all, let's start with the breakaway gap and the indicator. So in the previous video, we talked about a breakaway gap and the indicator. You can search for it as well. If you go to indicators right there and you search for breakaway gaps and breakaway areas right there, REO, that's our official indicator, essentially. So the probabilities indicator is also our official, but it's only for the MMT. So breakaway gaps, I wouldn't necessarily, first of all, rely on an indicator. I always think it's better to have the knowledge for yourself to first understand what the indicator potentially is doing. An indicator, I need you to understand, is never a replacement for a human being. So if you don't have the knowledge, then the indicator also can't really help you in that sense. It's very important to understand. A breakaway gap is all about if something is logical to create a retracement or not. So what I mean by that is, if we take a look at this fair value gap right here, at this fair value gap right there, at this moment in time, is it logical to create a retracement back into this fair value gap? Well, some might say, and some people that have watched my videos as well and that try to spread the word around breakaway gaps, they only say, well, you need to pay attention to the third candle right there. Because if the third candle is a new expansion phase candle, so a close above the second candle high right there, then this is a breakaway gap. That's not necessarily true. That's a very beginner-friendly way of understanding what a breakaway gap might be, yes. But a breakaway gap is not about that. A breakaway gap is purely about, is it logical at this moment in time to create a retracement or not? So at this moment in time, is it logical to create a retracement? Yes. Why? Because we retrace from and we get a rejection from a target. So we have reached a target right there that we can now create a potential retracement from. to then eventually still continue higher. That's important to understand. So that's the same if we have, let's see if we can find an example of this as well. It's the same if we have a very clear target in the form of a high, for example, then you would determine, all right, well, are we closer to the target or are we closer to now create a retracement back into the fair value gap? So is a retracement back into a fair value gap logical? That's all a breakaway gap essentially is. So if we take a look, let's see if we can find a good example of this as well. Let's see what we have. So this is a good example. Here we have this fair value gap. Now there's no close above the second candle high or anything like that, but it's still a breakaway gap. Why? Because at that moment in time, once we do create that fair value gap, then what do we see? We see that the retracement back into the fair value gap is 192, is further away than the target, 138. So it's more logical for price to first, and think of it like this, price is always about efficiency. So it's more logical to first reach the target, to then potentially still create a retracement back into the breakaway gap, to then continue higher from it. That's important to understand. So in the short term, before we reach the target, this fair value gap is not interesting. But afterwards, yes, because there's now a reason, there always is a reason to create a retracement. When there's a reason to create the retracement, now we can start looking at that fair value gap to potentially continue higher from it, if that makes sense. That's essentially all a breakaway gap is. So if you study that, then you get to a lot of the same conclusions, if that makes sense. So for example, why is this a breakaway gap right here? That moment in time. Well, because at that moment in time, the target that we have, which is also the daily fair value gap, is closer right there to continue lower from, instead of creating this deep retracement that we have sitting right there, if that makes sense. So that's essentially all a breakaway gap is. And then you can't predict a breakaway gap. So to a certain degree, you can understand the probabilities of what a breakaway gap might be and where it can form, etc. But you can't understand fully if it's truly going to be a breakaway gap. So it's always, the last step is always to a certain degree reacting. But that's anything in the market, and that's anything in trading, arguably. And we can have an understanding of where breakaway gaps should form, ideally. For example, we have something in MMT that's a huge giveaway sign that something is low probability. AVAX, right here, I mentioned for a very long time, this is low probability and not that interesting. Why? Because we have a bullish fair value gap right there. Why can't we continue higher? Because we're looking at context within context. So when we have context right here, from the fair value gap towards this high, and inside of that area, we create new context on the same time frame, it's not good. That is not what you want. Why? Well, simply said, because there's not enough momentum going for our trade, and there's a lot of momentum going against our trade at that moment in time. So this leads a lot to consolidations and potentially even lower prices right there. So this happens quite often when we do have context within context, not what you want to trade. And that's due to breakaway gaps as well. But in general, that's also talking about momentum. So hopefully that makes sense. Quite an important topic. And the indicator right there, again, you can search for it if you do want to. It helps you in understanding what a breakaway gap potentially might be, or a breakaway gap area as well. Candle signs right there, and a fair value area. We can first of all go over candle signs. Candle signs is something that is very interesting in my eyes. We introduced it a couple of years ago. And since then, we have seen a lot of different variations of what people determined to be candle signs as well, but they don't call it candle signs. And candle signs, to get back to the basics, is essentially understanding that when we move higher, fair value gaps are going to get created. When we move lower, fair value gaps are also going to get created right there. And it's not because the market needs to create those fair value gaps. No, it's just a byproduct. So what I mean by that, if we move higher right here, then what is going to happen? We are going to create fair value gaps. So it's a byproduct of moving higher. If we are going lower right there, we are going to create. And this is not something subjective. This is something objectively true. If we are going higher or lower, we are simply going to create fair value gaps because it's a byproduct of the market. It's what's going to happen, if that makes sense. So you can't argue with that. So people not believing in fair value gaps, you can't argue with the fact that if we are going higher or lower, we're always going to create fair value gaps. Always. It's just objectively 100% true right there. So that is important to understand, because that leads us to understand when we are creating candles like this, for example. Let's see. When we have this candle, then those fair value gaps allow us to understand as well what singular candles are doing. So that's candle science, where candle science is simply reading one singular candle, and based on that candle, we can understand what the next candle might want to do, because we understand what happens on the lower time frame in those candles. So if we take a look and we come back into this fair value gap, for example, and we take a look at this candle right here, what happened in that candle? Well, first of all, we open up, we might have continued lower at that moment in time, we then came back higher, then we came into the fair value gap right there, and then we continued lower again. So where are fair value gaps? Fair value gaps lower, fair value gaps higher right there, and fair value gaps at that moment in time lower as well. So that aligns with the idea of potentially bearish price action. So if we then take a look at the next candle right there, and what happens is that we can understand, because of that wick at the top, we can understand that that is a reversal through fair value gaps on the lower time frame. And it's not something magical. It's just a simple understanding of how the market works, how the market operates right there. So what we see right here is that we first have fair value gaps higher to then fair value gaps lower, which indicates to us there's a reversal, which then that turns into a long wick at the top right there on the weekly time frame. And again, that's not something magical. That's just a simple understanding of what the market is doing, how it's operating. So candle science can be a trading plan. For example, MT members like to use candle science on a daily time frame right there. So understanding when we have a large rejection right there, going to the 1 hour, for example, to look for a trade ID, combining it with 1 hour order flow. Because based on singular candles, you can understand what the next candle wants to do. Now, you can now also understand how this can help you in understanding what the third candle of a fair value gap, for example, wants to do. It goes very in-depth. And we have a very clear, structured learning path for that in the MMT as well. Less so on YouTube, I would argue, unfortunately. But that's essentially how the market works right there. So every time you have a large rejection, we continue lower, then what happens? It's candle science. Why are we all of a sudden right here struggling with this low? Look at the wicks right there. Those are fair value gaps. Again, it's very important to understand. So same here. When we see that previous week high right there, it's fair value gaps. So on Australian dollar, US dollar, we see something very similar right here. Let's see. First of all, if you start seeing it, you will see it everywhere right there, where every candle tells you what the next potential candle wants to do. We have this wick right there at the top. Then we reach this previous candle low. We sweep that previous candle low through that wick, through that one candle. That tells us failure to create fair value gap as well. So we can potentially target this high right there. Afterwards, this high, what happens? Well, not necessarily in the first candle, not necessarily anything. Second candle continues lower, fails to create this fair value gap lower right there. So what is happening? What are we looking at? We're just looking at a fractal market where we're looking at fair value gaps right here. Let's see. We're looking at, well, here it's very obvious, these fair value gaps, and that fair value gap along wick at the top or bottom. What is that on the lower time frame? It's just a simple sharp turn on the lower time frame. And here we have the same thing. And here, eventually, we get the same thing where we got those fair value gaps to continue lower right there. That's candle science. And then you can understand from candle science, and this is very powerful, is two candle rejection. So when we talk about candle science, we talk about a form of candle science is two candle rejection. Two candle rejection is understanding that from any PD rate that we have 2 times that we can reject from it. So a swing high right there, either the first candle is going to be a rejection, or the second candle can sweep the previous candle low or high to then create the rejection. 1, 2, okay. Then we see afterwards, or before it actually, that swing low right there. Or we see from this fair value gap, two candle rejection. It's a consistent thing. We see from this swing low right there. So two candle rejection is very powerful. It's extremely powerful. And what if a two candle rejection doesn't happen? Also tells you something. Because this first candle is a rejection. Second candle doesn't follow through. Instead, we get a two candle rejection from this low right there. So what tells us that this high might be failing right there. That we could potentially target that high instead. It's very, very, very powerful. Two candle rejection is lovely. And again, when you start seeing it, you start seeing it everywhere. And it's based on those It's based on candle signs, and candle signs then based on those fair value gaps. I need you to understand, I'm a trader. That's very important to understand, because when I trade myself, I get to certain conclusions, I gain experience in the market where I can then sort of, hey, this candle signs, that leads to also the understanding of two candle rejection, and then I use it in my own trading plan. So someone mentioned, can we talk a little bit about stick trading plan? Stick trading plan is based on just that. It's based first on me understanding fair value gaps. Then I studied that concept, fair value gaps, and I saw, okay, well, this can also then predict singular candles because of the nature of the market, leads to candle signs. But candle signs can be refined a little bit more, can lead to to candle rejection. And that leads to a stick trading plan. But for example, this fair value gap, if that's a good fair value gap you want to trade from, first candle is not a rejection. So two candle rejection, short guide. First candle is not a rejection. Second candle can sweep the previous candle low to then continue higher. So this in itself can then be what? Can be an entry where you don't need to go into the lower time frame to find those fair value gaps. That's a stick entry plan, if that makes sense. So that's the beauty of it, essentially. It's the beauty of it. I love it, but again, I can understand why people might not love it, but it's very powerful. If there's something I can recommend you to understand, is fair value gaps to candle rejection, because it happens over and over and over. And also, I want you to notice fair value gaps, and don't let anyone tell you, I'm quite passionate about this, okay? I'm quite passionate about my fair value gaps. So please, don't let anyone tell you that fair value gaps can be traded into multiple times, because that's simply not true. That's not true. And if anyone has studied fair value gaps, then you will know it's not true. So look at these fair value gaps. They get traded back into once right there. And if we do not continue higher from the fair value gap itself, then what happens? We sweep the swing low within the fair value gap to then continue higher from it. So either you, an MMT student, or another student that thinks fair value gaps can be mitigated multiple times, then that student might get caught up with trying to add a Fibonacci right here within the fair value gap, the 50%. The 50% right there, and then might potentially try to trade from it right there multiple times, because you can trade from the 0%, 50%, and 100%, etc. It's not true. It's not what you want to do. And the reason why is because you lose a lot of accuracy in the market. If we don't continue higher from the fair value gap, we will continue higher from the PD rate that is created within the fair value gap, which is 9 out of 10 times a swing low, or in a bearish fair value gap, a swing high. So we are not rejecting right here towards the left from that fair value gap. No, we are rejecting right here from the swing low. And look at the difference in accuracy. It's a huge difference maker in terms of accuracy right there. It's quite important to understand when we talk about fair value gaps as well. So let's understand fair value areas. So how do we then use fair value areas? Let's take a look at this again. Candle signs, I hope that makes sense. We can touch on it more again. Any topic that we have right here, we can talk about it for hours and hours and hours. I could do it might be a good idea actually. We can do maybe a 12-hour live stream once in a while, and we can talk about all the different topics that we have and how they tie into each other, etc., etc. But anyway, fair value areas are quite important to understand, because fair value areas are everywhere. They are everywhere. So fair value areas, to simply sum it up, are from intermediate highs and intermediate lows. Now, I need you to understand there is a hierarchy in the PD rates. So the PD rates that we use is number 1. And the reason why it's number 1 is because nothing else is valid without the fair value gap. Then number 2 is a fair value area. A fair value area also is essentially a little bit of a different understanding of what an order block, a mitigation block, and a breaker block is, essentially, if you're familiar with that. Then number 3, we have liquidity, which is essentially swing points. So swing highs and swing lows. Those are the 3 types of PD rates that we have. Now within that, we can get quite specific, the type of fair value gap that we have, the type of liquidity, etc., etc. But if we don't have a fair value gap, there's no fair value area. I need you to understand that very clearly. So right here, from an intermediate term low towards an intermediate term high, this is a fair value area right there, where if we want to continue lower, we will offer fair value right here to then continue lower from it right there. Why? Because the market is doing one of two things. So I need you to understand the market at any given moment in time, is either offering fair value or seeking liquidity. So what is that? Offering fair value is seen through a fair value area, but seeking liquidity is also seen through a fair value area. So both the answer to that question, if we are either offering fair value or seeking liquidity, is fair value areas. So right here, if we do want to continue lower, then look at this from a logical standpoint. Okay, what is offering fair value? We have continued higher right there. So buyers got a fair chance to get involved. We've also continued lower right here. So sellers got a fair chance to get involved. Where is the only area where buyers did not get a fair chance to get involved just yet? Is below this low right here. Because that's where sellers only got a fair chance to get involved right there, right? So logically speaking, where both in this area, both buyers and sellers right there got a fair chance to get involved. The market's all about offering that fair value. Why we use fair value areas, why we use fair value gaps, etc., etc. Otherwise, the market would just be, like we mentioned earlier, a straight line down or a straight line up if it wasn't about offering fair value. So what happens? This is a fair value area where we have offered both buyers and sellers a fair chance to get involved. So that means that this area is the only area below this low where we have not offered buyers, so one side of the market, a fair chance to get involved. That means that towards this low is the furthest area that we can potentially see a retracement. Now we can have a little bit of a sting higher right there, but we should not have a very deep retracement back into it to then continue lower. Doesn't make any sense unless we are potentially consolidating, etc., etc. So at this moment in time, we have now offered fair value. Why? Because sellers and buyers right here got a fair chance to get involved. So this area below this low right now is also fair value. Stick with me. So right here, if we are offering fair value, this right here is where the market can now continue lower from. Right there. But what happens? And this is a pattern that happens over and over and over and over and over again. It's a very important pattern to understand because this is such a giveaway sign. We try to push lower from the fair value area right there. What do we see? We fail to do so. Instead, we create these bullish fair value gaps right here. This is a giveaway sign that the market is not offering fair value anymore. Why? Because it offered fair value, tried to push lower right there, failed to do so. Now it's creating a deeper retracement back into the original fair value area that we had. Why? That's the question you should ask yourself. Why? Because we're not offering fair value anymore. So what are we doing? We are seeking liquidity. Where is liquidity? Liquidity is swing points, swing highs, swing lows. So what is the top of a fair value area? It's liquidity. So if we are not offering fair value in the fair value area anymore, what are we doing? We are targeting this liquidity right there. And this fair value area that overtakes the bigger fair value area turns into a flip fair value area where we can have deep retracements, whatever it might be, but we will not take out the low of the fair value area right there and to then continue higher. Well, we sweep the low right there. So to then eventually target that liquidity at the high right there. And this repeats itself. So if we continue right here and we look at all the fair value areas that we have, because what is this after taking out this high from that intermediate high to this intermediate low? What is that? A fair value area. So what do we see? If we want to continue higher right there, we will have a sting into the fair value area right there. And look at the accuracy. That's beautiful right there. Try to push higher, fail to do so. Instead, create those bearish fair value gaps right there. That's unusual context to then target the low of the fair value area right there. And this repeats itself consistently, where here, right there, we have, let me draw correctly, right there, we have a new fair value area right there as well. And this is fractal, so this happens over and over and over, because what is this? This is also a fair value area right there. And then that fair value area, what is important to understand, it tells us a consistent direction in the market of what the market wants to do. So that makes it, again, very interesting. How deep a retracement in a fair value area? Well, the fair value area tells you that. It tells you that. And the reason why it tells you that is because when we take a look at a fair value area, how deep can the retracement be? Well, if we understand that fair value area, and this is a fair value area right there, And how deep should we retrace? Well, where's the only area where we have not offered fair value just yet? That is below this low. So that line right there is how far we can retrace. Then usually what you'll see is that the first overlapping fair value gap, which is what? The overlapping defense we talk about in the MMT and on YouTube even, is what we will retrace back into. And if we do want to continue lower, we can continue lower from this right there. But if we fail this and token the rejection gets taken out, so can you see how everything starts to tie in to each other, if that makes sense? Because right now, token rejection fails. So now we are targeting instead this high right there, where this fair value gap, some people might see that fair value gap and think, well, we might want to continue lower from it. No. That's a bump in the road. That's a bump in the road right there to have a rejection from it, to then continue higher overall. It's not something you want to see lower prices from, if that makes sense. Stuff goes very deep, very in depth, but it all ties in logically to each other. And that's the beauty of it. So we can all explain it in to a certain degree, a step-by-step manner, which makes it very beautiful. Monster between 4+ hours. It would be funny actually to do that. To have a very long live stream. Yeah. I already checked gold. You can YouTube is beautiful in that. You can scroll back a little bit on the thing. And at the beginning I checked gold. Let's see. I didn't take a trade last week, actually. I didn't take a trade. You could argue I missed gold. I missed a few gold opportunities, which I'm not too happy with myself. But overall, I didn't take a trade. No resistance lags. It's also an interesting topic. Resistance area, high time frame. It's an interesting topic. So during live sessions, we like to tape read. And I'm not sure what we tape read. What is it? We were tape reading something last week and the week before as well. And what we do usually is we find an area that we can potentially look to trade, and we go into the 1 minute time frame to understand what is happening with the price action. Bitcoin, actually, we did this the other day as well with a live session. So in the 1 hour right here, we had this 1 hour fair value area that we can continue higher from. So what we do is, or this is just one trading plan, right? There's a whole lot of different trading plans that you can use and utilize in itself, but this is just one of them. So what we see right here is that we have this resistance area right there. You need to understand fair value gaps, fair value areas, they are stronger resistance areas. Why? Because there's a more momentum against our trade. Meaning if there's only swing highs right there, then there's not necessarily a whole lot of resistance. But if it's a fair value gap, that means we can potentially continue lower from it, right? There's more resistance. It's stronger resistance, if that makes sense. So right there, what we take a look at is if we go into the 1 minute, we sting into the, there it is. Let me actually select the right resistance areas. We have this resistance area right here. Then the only resistance that we have, let me break this down again before I go too fast. What is resistance? Resistance is opposing PD rates. So something that can withhold price from reaching a certain target. For example, if we want to reach this target, what is holding price back from reaching the target? This fair value gap right there, where we can potentially continue lower from this fair value gap instead right there. So we are expecting discount arrays to hold. That creates a bullish trend. So opposing PD rays are bearish. The premium arrays, the bearish PD rays right there. So bearish fair value gaps. So when we sting into that, let me see. And on the 1 minute, we went into the 1 minute right there. We can understand from a token rejection standpoint again, what is happening right here. Well, we first have this rejection high. And after we have this rejection high right there, once we start to get comfortable above those highs right here, then we have overtaken this fair value gap. So we have now disrespected that fair value gap right there. Once we disrespect this fair value gap right there, we only have swing highs left until we reach this target right there. So this is where price action can then run fast right there. Why does price action run fast? Because there's no resistance. There's no resistance run. So you might think, well, Ario, this is beautiful in hindsight right here. This exact trade right there was broken down live. As in, we took a look at it live right there. I mentioned exactly, well, here, this area right there is where we can then start running, where price action will be fast, because that's the no resistance area. It was completely live. So there's no argument about that, if that makes sense. So that's essentially a no resistance area, no resistance run, if that makes sense. Can all be broken down quite objectively. What are your educational qualifications apart from trading? Nothing really. Nothing. In all honesty, I studied computer science, but for the rest, I don't have any educational qualifications, so I'm not a qualified teacher or anything like that, if that makes sense. As in, I didn't study how to become a math teacher or anything like that. I think, I think why I'd like to believe I'm quite good at teaching is because of the fact, my humble opinion, because of the fact that to understand it for myself, I like to break things down to its core understanding. And that's why I'm able to also then teach it quite easily, because I understand it for myself, how I've broken it down to a certain degree, if that makes sense. Makes explaining a lot easier. Yeah, no resistance is, some people really like no resistance, Percy. Yeah. The fast price action. Some people love it. Swing highs are resistance, yes. Yep. But, Sandor, it's important to understand it's less resistance. So it's less strong than that fair value gap. That's why I mentioned that earlier on. And the reason why that's important to understand is because of the fact that at those swing highs, we can potentially stop for a short term right there to sting back into a fair value gap to continue higher. But at fair value gaps, you will see bigger, more difficult price action. So we will stop longer right there, if that makes sense. I I really don't get why I get this question so often, but I don't use CRT. I have no idea what it is. Please understand that. So I'm also not going to break anything down. People say it was stolen from candle signs. I couldn't really give a shit, if I'm being honest. So please stop asking me to do anything with CRT or anything. It's quite odd. It's quite weird. I don't know what it is. I don't use it. I don't need to use it. We have all the tools that we need here. So please stop asking me. In all respect. It's just it's from what I understand it's just potentially another shiny object syndrome thing. Stop, okay, stop, please, thank you. It's like I don't know. It's how can I compare this? Like asking I don't know, someone else about someone else's profession. Like it doesn't make sense. Computer science to candle science, yeah. Exactly. How did you convince your parents to be a trader? Well, convincing. It's very hard to convince, especially something like trading, and especially, well, online with anything that you do now, right now, because I think, well, my parents are, of course, of an older generation. So there's nothing to understand there, if that makes sense. As in, you can try your best to make it make sense, but they will never fully understand it, if that makes sense. And the only thing you can do is really show them with results so that you're able to provide for yourself, if that makes sense. And then whatever it may be, they'll be happy for you, but then they'll somewhat understand it, if that makes sense. So try to convince them. It's difficult, very difficult. I sent you an email 2 weeks ago, but haven't gotten any response. But nobody is answering my messages in the free Discord either. What can I do? Alex, that is very odd. Can you reach out to info? But again, if you send an email, I'm not sure why. Because we generally speaking answer all the emails that we get. So unless you say something extremely crazy, which I don't think so, we answer all the emails we get, we answer all the messages we get, etc. But it might be the case that it ends up in spam or an inbox where we generally speaking don't see it. So in that case, please feel free to reach out to the Discord again, and please tag Chelsea and Derek. So that is Chelsea and Derek right there. If you tag them, then you most likely get a reply right there in just a primary chat as well. I'm sorry to hear that, Alex. That's odd. That's very odd. Like asking Ronaldo how to be a doctor. Yeah, it's I don't know. Yeah. You too, Milan. You too. Have a great day. Yeah, that's it, Darren. Don't ask your parents proofs and success. Success takes time. It's yeah. Yeah. It's a good one. Any tip for break-even stage? Break-even stage is it's an annoying stage, but it's a very difficult stage to go through. And the answer to break-even stage, getting out of it, is just simply looking at trades you have taken, seeing if you can improve from it, and then from there gain that experience to then potentially improve on it as well. Better late than never. No worries, no worries. And you can always watch it back, the live stream. No worries. No worries, my friend. It's quite weird to me. It also sent 2 emails and tried to ping the support over 5 times, but also didn't want to spam. Alex, in that case, you have my permission right now. If you don't get an answer from support, you have my permission, all my permission in the world, to spam. Of course. I need to nuance that a little bit. Don't spam like annoying spam where the first reaction from support is to time out you or ban you or anything like that. But just send frequent messages over a prolonged period of time, if that makes sense. But support should always be certain replying. And if they don't reply to emails or anything, then likely something went wrong. Because that doesn't tend to happen. And we have multiple people even checking the emails as well afterwards. So it's very unlikely to happen unless it's in a certain inbox or didn't arrive, etc., etc. Can you make a payment method so Nigerians can pay to join MMT? What would that payment method be, my friend? There's a specific one for that? What was the motivation that you ended up creating your own concepts? There's not necessarily a specific motivation for that. I learned a lot from ICT, so all credits to ICT for that as well. And I'm very grateful for that. I took a lot of basic things away from ICT. So for example, a fair value gap that was introduced to me by ICT. But that third candle, etc. A lot of people think a lot of people even think that I'm the son of ICT. It's not true. Or that I was in a special mentorship with ICT or anything like that. It's also not true. It's quite funny. But I didn't get taught the third candle, or I didn't get taught a certain fair value area, for example. What I think is very important, and also for your own trading, eventually, a mentor teaches you certain concepts, and eventually you want to take your own logic and build onto that logic, build onto those concepts, if that makes sense. So case studies, I did a whole lot of case studies, like a whole lot of case studies. And from that, I got to certain patterns that I noticed, etc., that led me to sort of not invent, because I don't want to call it invent, because I'm certain people have come to a similar conclusion, but they might name it different, etc. But I came to a conclusion of my own concepts, quote unquote, own concepts right there, if that makes sense. I'm the special son that didn't go into college, yeah. From a different father, though. From a different father. Likewise, pet lovers. Likewise, likewise. Let's see. Ramon, how are you doing, sir? Can you explain time intervals in candle science, how you use it? What do you mean exactly with that? Yeah, I think, Adam, that's also a good point. You know, a big part of the MMT is we try to create, as best as we can, sustainable, self-sufficient, sustainable traders. So what that means is that you don't need to be in a certain Discord, you don't need to be watching certain videos, etc., to be profitable, because that's essentially the goal. We don't want you to be reliant on someone, for example. And so far we have done good, but sometimes that also is the case. Yes, it's a difficult decision, but that is very important. To take the next step, sometimes you have to be alone. Yeah. People are doubting me becoming a trader. They say, all they say is I'm lazy. People will always have doubts. Every big thing, and like, of course, that might be a crazy exaggeration, but every big idea that humans had, the internet was also doubted by people. Everything new is a little bit scary to people. So if they say, if you are saying you're going to become a trader, it's like, it's probably not within their idea of how they think of you, etc. So it's usually easier to say, well, you're going to fail, etc., etc. I don't know why that is. Just human nature overall for people to be like that. But again, I wouldn't worry too much about it, what other people are saying or thinking. Just prove it. Prove it. I'm Legend MMT, by the way. You probably, I do, of course. Of course, I remember you. Up 7RR this year so far. Wish me luck. Love that, Adam. Love that. Hence, that makes sense. Hence why you're saying it. Yeah, okay. Yes, AT trades. Yes, yes, yes. Correct. The Discord lives in MMT, they are always rewatchable. Then they always get recorded. And not in the free public Discord, but in the paid one. What is the shortest time a student of yours got funded? Within a few weeks. But again, I need you to understand that's not the average. That's not the average at all. It's very important to understand. It's I'm not trying to say here, if you follow the MMT, you're going to get funded within a few weeks. No. Because, for example, when someone arrives in the MMT, usually they already have a lot of knowledge from YouTube as well. So there's a lot of years, potentially months, years of work that went on before that to then dive into it, for example. So it's very nuanced. It's very nuanced. And if it takes you longer, then don't worry about it. Don't worry. Don't worry about it. It's important to understand if it's truly something you want, then the time frame on it shouldn't really matter. Because what else are you going to do? You're going to do something that you don't want? Doesn't make any sense. I have an old one, Harsh Arts. I have an old one if you're interested in that. A very old one. I believe it's in the A to Z guide, even. How do you know, Ivan? How do you know? How do you know, my friend? Emmanuel, you can check if you want. You can simply check tradingmmt.com right there, and all the information is there. And if you do have any questions for us, feel free to ask us in info@tradingmmt.com. All right. How do you know, Ivan? Because I am going to end it here. Thank you, everyone, for being here. Great live stream. Appreciate it, all of you. Much love for all of you. Thank you. Thank you very much. Have a great Sunday. Rest of your Sunday. For some people, it might already be Monday even. If that's the case, sleep well, take your rest, and get ready for a new week as well. All right. Thank you, everyone. Thank you, everyone, for being here. Take care. I'll see you at the next video as well. And of course, every Sunday, 11 a.m. New York local time, we're here doing a live session. Perfect. Thank you, everyone.